Hi, my name is Shakira. I will be explaining about Musharakah. What is Musharakah? Musharakah is a joint enterprise or partnership structure in Islamic finance in which partners share in the profits and loss of an enterprise. Since Islamic law Sharia does not permit profiting from interest in lending, Musharakah allows for the financial of a project or company to achieve a return in the form of a portion of the actual profit according to a predetermined ratio. However, unlike a traditional creditor, the financial also will share in any loss should they occur, also on a pro rata basis. Musharakah is a type of shirkah al-amwal or partnership, which in Arabic means sharing. Moving on to next, which is type of musharakah. In general, musharakah is divided into two types. Firstly, partnership in joint ownership, shirkah al-mix. It means the joint ownership of two or more persons in a particular property. The basic feature of shirkah al-mix is to mix the ownership either by choice or mandatorily. If two or more persons purchase an asset jointly, they become the owners of the asset. This partnership comes into existence as their own choice, because they themselves choose to purchase the asset jointly. In second type of shirkah al-mix, the partnership is established mandatorily or automatically without any effort or action of the parties. For example, after the death of a person, all his heirs become the new owner of his property. They become the joint owner through the law of inheritance without any effort or action. Secondly, contractual partnerships, shirkah al-aqd. Shirkah al-aqd is a type of partnership which is established by the mutual contract of the parties. It is most widely used in business transaction and can be translated as contractual partnership or joint commercial enterprise. Basically, it is an agreement between two or more people to combine their asset, labor, or liabilities for the purpose of profit making. All the parties enter in partnership contract willingly and share the profit and loss of the joint venture. In contractual partnership, the partner may contribute capital, reputation, or services. From this perspective, the contractual partnership can be further. So, for the detail, I will show what is musharakah example. For example, suppose the individual A wants to start a business but has a limited funds. Individual B has excess fund and wish to be the financier in musharakah with A. The two people will come to an agreement to the terms and begin a business in which both share a portion of the profit and loss. In conclusion, although not as popular as other Islamic financial instruments, musharakah is still considered to be one of the most authentic forms of Sharia-approved financing. Recognizing the problem that some financial instruments used by Islamic financial institutions closely resemble interest-bearing instruments, Muslim scholars have voiced their opinion that more profit and loss-sharing instruments should be developed and used. Also, by relying on musharakah for financial projects, Islamic financial institutions can erode any fears that Islamic financial institutions are essentially providing interest-bearing product under the guise of profit, and markup has hurt their reputation. This is important for their survival and future growth of Islamic finance.
What is Murabahah? Murabahah refers to the sale contract where the seller sells the price at profit. In a simple word, Murabahah means cost plus profit sale. In a Murabahah transaction, it is a requirement for the seller to inform the buyer the cost to purchase the asset and the profit that he makes in addition to the cost. Technically, it is a contract of sale in which the seller declares his cost and profit, which is then sold to the client at a mutually agreed price. For the conditions for Murabahah, in Murabahah contract, the following elements must exist or satisfied in order for the contract to be valid. The first one is both buyer and seller must meet the condition as the contracting parties. And the second one is the subject matter in Murabahah contract must fulfill the condition as subject matter. Specifically for Murabahah contract, the seller must clearly disclose the price and the profit margin to buyer. And the third one is the offer and acceptance between the seller and buyers must also fulfill the condition for valid contract. Application of Murabahah contract in Islamic finance. The diagram below illustrates the application of Murabahah concept in Islamic financial contract. Islamic financial institution, as the seller, sell the asset that it owns to the customer, which is as the buyer, and the asset selling price comprised of its purchase price and profit margin. So the customer will in return pay the selling price on cash or deferred payment through installment. Murabahah contract is commonly available for term financing, working capital financing, and personal financing. The example of Murabahah, the Al-Musharakah, if the Al-Musharakah pay is fixed amount to a bank that owns the asset and there is no interest charge involved. Also, if Shirkah default on any payments, there is no additional charge that she would incur. The additional amount Shirkah pays over the cost price from the boat shop is in effect 3% loan. But because it is offered as a fixed payment without any additional cost, it is allowed by Islamic law. So the conclusion is, in Murabahah contract of sale, a client petitions a bank to purchase an item on their behalf. Complying with the client's request, the bank establishes a contract setting the cost and profit for the item with repayment typically in installment, because a set fee is a charge rather than riba, which is interest. This type of loan is legal in Islamic countries. Islamic banks are prohibited from charging interest on loans according to the religious tenet that money is only a medium of exchange and has no inherent value.
Murabahah is a partnership in profit whereby one party provides capital and the other party provides skill and labor. The provider of capital is called Rabul Mal or Shahibul Mal, while the provider of skill and labor is called Mudarib. Profit sharing is the primary motive of a Mudharabah contract, and therefore it is a fundamental component of a contract. An Islamic bank can enter into a two-tier Mudharabah agreement between the bank and the depositors who agree to put their money into the bank's investment account and to share profits with it. Mudharabah is divided into two types. The first one is unrestricted Mudharabah or Mudharabah Mutalaqah. An unrestricted Mudharabah is a contract in which the Rabuma permits the Mudarib to manage the Mudharabah capital without any specific restriction. The investor authorizes the entrepreneur to run the business without restriction in terms of types of business activity, products, location of the business activity, as long as business activity does not violate the principle is in the Islamic law. The second one is restricted Mudharabah or Mudharabah Muqayyadah. A restricted Mudharabah is a contract in which Rabul Mal imposes specific restriction on the Mudharabah terms. The Rabul Mal may specify conditions restricting the Mudarib, such as the determination of the location, period of investment, the type of project, and commingling of funds. For an example, Ali, an investor, while Abu is entrepreneur, start doing Mudharabah business, and Bilal as investor want to invest 100,000 ringgit onto their business, and Abu will share the profit as doing his work as a partner with an agreement. One day, Abu supposedly need to invest another 50,000 ringgit to their business with the permission of Bilal. In this case, Abu will take profit because of the investment he did also as a working partner, as he did all the job in their business. Financing through Mudharabah does never mean the advancing of money. Mudharabah, it means to participate in the business. An investor or financier must share the loss incurred by the business or to the extent of financing. The partners have the liberty to determine with mutual consent the ratio of profit allocated to each one of them, which may differ from the ratio of investment. However, in case a partner has expressly excluded himself from the responsibility of work for the business, he cannot claim more than the ratio of his investment in the project or business venture. In case of loss suffered in the project, each partner must bear the loss exactly in the proportion of his investment.
The Islamic banking concept that I will explain is Al-Wadiah al-Damanah. What is Wadiah? It is a term that often gets thrown around in the Islamic community, but what does it mean? It is different from card, and the concept involves safekeeping, custody, and trust. Wadiah in Islamic banking refers to a deposit. It involves entrusting one's belonging to another for a specific number of days without paying any fees. For ease of understanding, let me simplify it a bit. Imagine you own a property and want it to be in the safe hand of someone else named Umar. If Umar accepts your property for a specific period for safekeeping without charging any fees, this is what is Wadiah contract. Next, I will explain Wadiah in Islamic banking. In our case, asset that you deposit is a liability on Umar. When speaking of an Islamic economic system, it is done by Islamic financial institution through Islamic banking. When you deposit your fund or asset into an Islamic bank for safe custody, this is generally known as Wadiah. However, many Islamic banks charge a nominal fees against any safekeeping they provide for their clients.
For the key principles, Islamic banks offer a variety of non-profit Wadiah products. Islamic bank is liable to return the funds on specific period. The depositor of funds allow the bank administration to use his proceeds for investment purpose in Sharia compliant mode. Islamic banks bear the entire risk of investing fund that they obtain from the contract, and bank must return the original amount to the owner at any time. The difference between Wadiah Yad Amanah and Wadiah Yad Amanah. Its two types are different from each other in their application, which is the first one is Wadiah Yad Amanah. Wadiah Yad Amanah involves safe custody of deposit based on trust. The custodian of the property maintains safekeeping of the funds with due diligence without receiving any profit. He also bound to return the funds on demand and cannot use the assets for investment. Wadiah Yad Amanah, on the contrary, Wadiah Yad Amanah acts as a guaranteed safe custody, so banks can utilize the property for investment purpose and have a right to receive profit generated by funds. However, they may also be fully responsible for any damage.
It is a key term in Islamic finance that revolves around the safekeeping of one's funds by another party, and it is classified as Wadiah Yad Amanah and Wadiah Yad Amanah. The ownership of funds remains with the original depositors and they can claim the amount at any time. However, in the case of card, this ownership transferred to the depositors of bank, which can utilize their fund for profit generation. It, along with several other Islamic financial instruments like Mudharabah, are explained during the online Islamic finance course and diploma in Islamic banking, and also finance programs at AIMS.